Well, it's a pharma company that has outperformed its peers this year with an over 40% gain year to date and is now getting future ready. Cadila Healthcare's Mr. Pankaj Patel, who has grown the company from a turnover of only around 250 crores in 1995 to a billion-dollar company today, has stepped down as managing director but will remain chairman, while his son, Dr. Sharvil Patel, is taking over the reins as the new managing director of the company. We are now joined by both Mr. Pankaj Patel, the chairman of Cadila Health, and Dr. Sharvil Patel, the new MD of the company. Thanks, gentlemen, for joining in. Sharvil, let me start with you. You've been a part of the company for 2 decades, but now you'll be handling the company on a day-to-day basis. What are the opportunities and challenges you foresee?
The biggest opportunities for our company is the research pipeline that we have been working very hard at for the last 2 decades. Ever since 2000, we've been working on our new chemical entity pipeline, our biologics and biosimilars product portfolio, and our new emerging vaccines portfolio. And we are seeing tremendous opportunity going forward for all of these 3 portfolio as clear differentiators for ourselves in both India, emerging markets, and also some of the developed markets. So I and our team is very excited about this opportunity that we might be poised to deliver on in the next 5 years.
Okay. Sharvil, you were at the helm of the Moraiya facility clearance, and it is a big, a big achievement for the company, considering that you all had a warning letter in December of 2015 and you managed to successfully get 0 observations from the US FDA. What is your biggest challenge, say, when it comes to regulatory issues, especially with the Moraiya plant? What can we expect from Cadila? And what is the kind of focus that you have when it comes to the US FDA?
So I think the regulatory and compliance is an ongoing journey. We have done well in this year in terms of our audits, but I think it's a continuous journey that we have embarked upon in terms of enhancing our standards and going beyond compliance. We have done a lot of initiatives in our facilities, all the way from automation to simplification to making sure that there is good accountability and ownership at the facility levels. We have a very thorough review mechanism for all our facilities in terms of both compliance and quality metrics. We are following the FDA's quality guidelines and metrics and trying to make sure that we are on top of it in terms of what the FDA and the other regulators expect out of our facilities. So it's an ongoing journey. We have taken initial steps. We keep an eye out for all the external observations that are made and make sure that we are able to keep up to date with those observations and make sure that we are able to adhere to the changes in the FDA and the improvements in the FDA guidelines. So I think it's a journey that we have embarked upon. We are very happy that we had a successful audit this year, but I think we are as good as the last audit and we need to continuously improve.
That point is well taken, Sharvil, as good as your last audit. But these are day-to-day matters. You are now at the helm. You have to give the company the vision. How are you different from your father, Sharvil?
So I think I don't see myself very different from my father in terms of our vision. I think we are very well aligned. Ever since I joined the business, my vision was also similar to what he has aspired to build, which is to build a research-based pharmaceutical company. And my endeavor is to make sure that our innovation portfolio becomes very strong. We have moved a lot of products from the bench to the clinic, and we need to make sure that we successfully complete our clinical trials and make sure we are ready for these products for the global launches. And so we are going to be strongly driven to make sure that this portfolio comes to market, which is very value additive and enhanced for us. So all when it comes to NCEs, biologics and vaccines, we are working. I want to work very hard with the team to make sure that what we have envisaged and what we have planned for comes to fruition in the next 5 years. So that's something that is going to be very important going forward. And then finally, compliance and quality has to be as the benchmark for the industry, and we want to work very hard to make sure that we keep applying ourselves to make sure we have the best in standards in terms of quality and compliance.
Mr. Patel, let me put the same question to you. What is that one dream which you perhaps could not complete and you want Sharvil to do it for you?
So I think my dream was to make a complete research-based pharmaceutical company, which is still a work in progress. And I'm happy that Sharvil also has a similar idea and dream to actually make it happen, and I think that is what I want to see, that world knows India as an innovative pharmaceutical company from India, and also a world knows that India can innovate and contribute to the overall healthcare of the world.
I mean, to the question of how you will be different, I think investors will be very happy, Sharvil, if you are exactly like Mr. Pankaj Patel. I mean, the stock is less than 10% away from a 52-week high. I mean, just from a pure market perspective. So it's done phenomenally well in a sector where others have suffered. I just want to stick to that point, R&D. One of the things one hears from investors is that beyond FY19, what is the visibility that you have in terms of growth? And one of the pushbacks in a way, which one hears, is that Cadila, as compared to other pharma majors, isn't spending that much on R&D as a percentage of sales. Could you throw some color and light in terms of how you think about this? And if you have any specific numbers in mind in terms of increasing that?
So I think, I personally don't agree with the spending as a benchmark of true R&D. Most of the innovative or differentiation or breakthrough developments across the world have not happened by just spending a lot of money. So what we truly believe in is to make sure that we work on the right therapy targets. We work on differentiated targets. We work on first-in-class targets, where the barrier of entry is higher, but the rewards and recognitions are also higher. And if you look at some of our programs, they are poised to be the breakthrough therapies. So I think that the spending is dependent upon the kind of products and portfolio you select. What I think I have significantly learned from our chairman and seen in the last 15 years is that we have been able to do a lot of this effort in-house. We have built all these core capabilities all the way from preclinical to clinical in-house in terms of what our scientists are able to do, and that helps us to maintain our costs lower, because we are able to not only execute faster but also maintain our costs. So that has been a differentiator for us compared to many of our peers, that we have focused strongly on building core capabilities inside the organization and not outsource these capabilities, and that has helped us both in terms of time and efficiency, and we are able to deliver more projects in a similar amount of money. So I feel going forward we should be around the same range-bound effort in terms of our R&D spends, which is between 7 to 8%. Once we reach our phase 3 programs, and if we need to invest more, we will look at that. But currently we are able to manage our biologics, our vaccines, our NC pipeline in the current R&D spends we are managing.
Okay. Sharvil, you take over the company as the managing director in the same year that Trump is chosen as president in the United States as well. Nobody can stop talking about how exactly drug prices are probably going to see new levels or new lows in the US markets. On the other hand, we also have India, where there is that generic prescriptions which could probably become a reality soon. If you had to talk about how you're going to combat the challenges in the US on one hand, as well as India, where both in terms of commonalities, drug pricing pressure, how would you do it?
So I think these are more external factors, and I don't think we can control external factors. What we need to do and what we have decided is that when there will be pressures on pricing, we have to make sure our operational efficiency improves significantly in order for us to maintain our margins. So our endeavor has been to continuously improve the efficiency, both in terms of operational efficiency as well as cost. We have been working for the last 5 years. It's not something that we just started to do, on different initiatives where we are able to optimize our cost and remain competitive both when it comes to the domestic business as well as the international business. The external indicators will affect each and every company in the same way. So what we need to be is just agile and make sure that we are competitive when it comes to our positioning in terms of efficiency as well as cost.
On that issue, Mr. Pankaj Patel, is there a danger, a negative point that you want Sharvil to avoid? Probably a mistake you made which you want him to avoid, or an opportunity you missed. What would be your advice in what he should avoid as red flags?
So I think I would always tell Sharvil not to just do an M&A for the sake of increasing top line, but be very focused on value addition on any merger, any acquisition. He also should actually focus on remaining on top of the cost of operation to make sure that we are always competitive we are a generic industry. By name of that nature of the industry, it is going to be always hyper competitive, and it's going to be very important that efficiency at all levels are continuously achieved to ensure that we are successfully competing in the world and maintaining our market shares and margins.
Mr. Pankaj Patel, you took away my next question. Actually, that was my question to Sharvil. Would you look at inorganic moves a little more aggressively than your father did?
So my view is also very similar. We don't want to do M&A just for the revenue recognition point of view, unless it is very strategic and unless value additive in the next 3 years of the transaction. We don't want to be spending our resources behind that. We have a lot of development and R&D portfolio that we have for ourselves. We would rather adhere to making sure we invest behind research and the pipeline that we want to create. But as geographical expansion happens, as opportunities come up both from brands point of view or specialty business point of view, we will keenly explore those opportunities, and if we are able to give a good payback to our shareholders, we will definitely go ahead and do M&A, but we are not going out of bound in terms of going crazy on M&A.
Would it be a company, Sharvil, or would it be, say, specific assets, say like, for example, one API plant of an X company, etc.?
It is a mixed. We don't have. I mean, it will depend on the geography and market specific ideas. In India, mostly it could be brand specific. In the US, it could be a mix of brand as well as a company. But I would say it is different for different geographies.
Well, all right. On that note, gentlemen, request you to please stay on. We just have to take a break, and we'll be back to continue our conversation.